Hello, welcome everyone to my Founder's Guide to Fundraising. My name is John Henry. I'm co-founder and co-CEO at Loop. We are a venture-backed insurance company on a mission to create fair insurance for all. But that's not the only side of the table that I've been on. I also co-founded the venture capital firm called Harlem Capital, where I raised over $40 million and invested in over 20 companies at the seed stage. I've also angel invested my own cash into over 10 companies. I've run an incubator, I've run an accelerator. I've been doing this for over 10 years now, if you could believe it. And I have learned the art of raising money at various different stages at this point fairly well. So I am going to walk you through understanding venture capital as an asset class in finance, understanding the landscape, understanding how to navigate the landscape, how to craft your materials in a way that can make you compelling, how to land those first meetings, how to follow up and systematically categorize all of the conversations that you'll be having, how to turn those conversations into commitments for investment, and ultimately how to close the deal. And then the fun part, what to do with the money and how to rinse, wash, and repeat and do it all over again. So lock in with me. I believe I'm one of only a handful of people in this country under 30 years old that has ever raised a venture capital fund backed by institutions. I've raised several rounds of venture capital myself for as a founder. And in general, I feel very highly qualified to give you this information. So I'm very excited because there's a lot of mysticism around VC, but this is an area that I know well. So buckle up, let's go for a ride, and let's get into the show. Let's unpack the first key area here, which is understanding the investment landscape. Now, I know what you're thinking. VC is all the rave. It's all in the news. You want to be on Black Enterprise for having raised that record amount of capital. But where does VC actually fit with respects to all total invested capital? As you know, likely, there's many different types of capital that's invested. There's all different types of vehicles and instruments. Well, what are they? There's debt, there's equity, but most of equity goes towards safer investments like bonds and ETFs and indexes and endowments and so on. And if you look at the total invested capital, there's a tiny sliver called alternative investments. And if you zoom into alternative investments, this is code for the riskiest type of capital that there is out there. If you zoom into alternative investments, then there's an even tinier sliver still that's called venture capital. Now, venture capital is the riskiest asset class in just about all of investing. And that's important to understand because secure, less risky types of investments have typically lower return on investment. So if you invest in a bond, you're going to get a 3-4% return. You're not expecting it to move mountains. You're also not expecting it to go to zero. And typically, the more risky you go with the type of asset class that you're pursuing, the more returns you need. Why? Well, because the riskier it is, the more likely your capital is going to go to zero. So as an investor, for example, if I were to invest in 100 companies, there's a good chance that at least 80, 85 of them are going to go to zero, which means that the 15 of them that hit and do blow up, I'm expecting a very, very large rate of return to overcompensate for a lot of the zeros that I had. Now, if that seems difficult to absorb in one sitting, then just watch this over and over if you have access to it, because it is an absolute imperative foundation to understand about venture capital, because you must internalize the intrinsic, very risky, but very large swinging nature of venture capital. This is not a loan where I'm going to give you the capital and you're going to give me a 6%, interest rate. This is not private equity where I invest and then I want cash flows every year. This is home run, go big or don't go at all. I'm perfectly fine with you being a 0, but if you do hit it, I'm looking for you to be 100x return on my capital. That is the understanding that we need to establish at the ground floor before we can proceed to understanding a little bit more about the VC landscape. So hope that helps. Okay, so now that you know that VC is the absolute riskiest asset class, now let's unpack it a little bit, because it's still a very fast growing sector of the marketplace. There's over $200 billion invested annually into venture capital. Even though it is a tiny sliver of the overall pie, it is a slice of the pie that is growing and fast. And it's not enough to look at VC as a monolith. Let's understand the different players that play a role in all of venture capital. So the first player that you have are your angels. You may have heard this term before. And all an angel is someone that invests their own money directly into a business. They're not investing out of a fund. They're not investing out of a syndicate, which is a group of people. They're not investing out of a family office, which is funds from one individual family. They are investing as an individual. So if me, John Henry, for example, were to write a $10,000 check into your company, then I'm an angel. And angels are really crucial because they typically don't need you to be as far along. So a lot of your first funding is going to come from angels. And the very important thing to understand about angels is most angels don't even know that they're angels, meaning oftentimes these are people that don't consider themselves professional investors. They may just be professionals in an industry, and they've been, let's say, working for 20, 30 years, and they've put away some money, and they believe in you as an individual, and you can convince them to write you a 5, 10, 25K check. Oftentimes, angels do not write checks any bigger than 50,000. Most of the time it's 25,000. A lot of the time it's 10,000. So as you can see, you don't look to angels to make it rain. You look for them to build some initial support and momentum. And so that's the first player to understand, are these angels. The next player to understand are VCs. So what makes a VC? Well, I think a lot of people don't know this truly, but a VC does not invest their own money. A VC goes and raises capital from other capital sources. What are those capital sources? They could be an endowment from a school. They could be state endowments, pension funds, family offices, other larger funds, individuals. Whatever the capital source is, a VC also has to go out and raise capital. And what they're doing is they're pitching them on their ability to find good deals like you. And they have to develop what's called a thesis, which is similar to when a VC asks you, hey, well, what are you going out there to go and solve? They have to answer the same question to their investors. And so what are some common theses that exist in the marketplace? For example, one very popular thesis is, I'm going to go invest in women and minorities. So it could be a diversity thesis. You could have a geographic thesis. Hey, I want to invest in companies in Baltimore, or I want to invest in companies that are outside of Silicon Valley. I want to invest in companies that are in the Midwest. So that's another type of thesis. Another common thesis is industry specificity. So, hey, we want to invest in cryptocurrency. We want to invest in sports. We want to invest in media. We're going to find the best deals in pharmaceuticals, you name it. The point is that each fund, it's very important to understand this. Each fund has its own physics. They have pitched their investors on a business plan. And when the VC is able to round up all of their capital, that they have now what's called a fund. Okay. And a VC over the course of their business will raise many funds. You start with the first fund. After 3 years, you raise another fund and another fund and another fund. And what they're looking to do is execute on the business plan. And it's important to understand this because you should not go to a fund. I don't care if it's your homie or you know them or your cousin knows them. If that fund does not invest in your industry, your geography, your stage, that could be another type of thesis is, hey, I focus on seed stage. They might focus on Series A, Series B, and so on. Then you're wasting their time, you're wasting your time. But it's not, this is not a product of anything other than being exposed to the VC landscape and really making tremendous sense out of it and where you fit inside of it. So those are the two big components. There are angel investors. They typically go earlier and it's an individual. The moment you hear the term VC fund, you should understand that they're professional investors. They're investing other people's money. They sold their investors on expectations around financial performance. So they're typically looking for more traction. They're typically writing larger checks because, it's not their own money. They have more capital to pull from. And they typically have a business plan that they're looking to execute. So the better you can understand this, the more you can understand which specific types of funds and angels you should be going after. Hope this helps. Okay, so now you know that VC is super risky. And now we've unpacked the actual investment landscape and who the players are. So then the next question is, well, how do you identify compatible investors? Well, we teased the subject matter in the prior section, but it's all about aligning yourself to capital out there that is looking for you. Believe it or not, I know it sounds strange and it's difficult to accept this reality when you're new, but there is capital that is looking for you, specifically you. There are investors out there that, remember, we established these people have to deploy money professionally. Let's understand their motivations and their pressures, okay? And I can say this because I've been a professional venture capitalist. I've raised over $40 million as a VC to invest in women and minorities. And so what were my pressures? Well, I got to find the best deals. I'm looking for deals all the time. I'm looking to connect with people that know founders. It's a deal business. You're constantly looking for your next opportunity. So that's driven by a lot of FOMO, fear of missing out. That's driven by a lot of networks. So-and-so says that so-and-so is doing well. That's driven by, I heard that this fund is investing in this deal. There are a lot of really human components to this that are not too dissimilar from a lot of things that, it's like it's high school all over again, but with millions of dollars. Now, that said, how can you tap into resources out there that can minimize the amount of time that you're spending on funds that are not looking for you? So let's take an example. Let's say that, let's take Loop, for example. I run today an insurance technology company. And we already raised our seed round. We raised a $3.25 million seed round. And what was my approach to identifying compatible investors? Well, the first thing I did was I eliminated anybody who didn't invest in seed stage businesses. So whatever stage you're in, you don't want to talk to anyone that invests before or after. And doing this immediately eliminates 90% of the total options that are out there. And so by doing that, and you can go on blogs and just type in, the top seed funds in the US, the top pre-seed funds, the top Series A funds, and you'll find list after list after list, and you can begin compiling all this information. Now what you have is a very narrow focus of who invests in my stage. The next layer is, okay, who invests in my industry? So then I would filter through, and all of these funds, they all have websites, and in their websites, they typically have an investment page that lists out their criteria. And all of these VCs will list out specifically e-commerce or crypto or platforms or marketplaces or financial services, insurtech. So as a founder, I narrowed it down to my stage, and then I narrowed it down to my industry. What you will find is that many funds invest across industries. So it's going to take a little bit of discernment, because some of them say, oh, I invest in every industry. But when you click on their portfolio page and just use your eyes and go look through all the deals that they've invested in, and you'll begin to pick up patterns. Oh, okay, this fund says they invest in all these different industries, but in actuality, they're really over-indexed on consumer or on beauty or on e-com. And you're going to have to write down this note. And you begin taking notes, and you begin boiling down your total addressable list of VCs. And just to give you a proper and actual frame of reference, for Loop's seed round, we spoke to 76 VCs. Okay, so there's thousands of funds out there. There's probably several hundred funds that invest in seed stage, and there was probably only a number of dozen, about 100, that were interested in our industry in our stage. And that's what you want to go for. You want to target about 100 total funds that you can have a conversation with. Now, this doesn't guarantee that you'll have the conversation. We're going to get to that in the next section, how to improve your odds of having a conversation with these folks. But you want to boil it down to about 100 people that would take your opportunity seriously. And the great thing here is they're looking for you and you're looking for them. So it's a respectful way to consider their time and your time, and you're increasing the probability with which you will have that first meeting. So flowing into the next section, how to position your company for investors. Take one, marker. Okay, so now you have boiled down to the first 100 investors that you think would be excited by what you're doing. Now, the next question is, well, okay, how can I package my company in a way that is going to increase my probability of getting a meeting? And the answer is a pitch deck. Now, you've heard a lot about pitch decks. You've heard stories of people raising money on just the pitch deck and so on. And I can assure you that that's true. The pitch deck is phenomenally important. Now, this information you probably are not going to get anywhere else, because this is coming from a tried and tested founder, investor, incubator, accelerator. I've been on every side of this table. And I don't have decades in the game, but I got one solid decade in this game. And one thing I can tell you for sure is about VC pitch decks. Now, I've looked through over 2,000 decks as an investor, and then I've made dozens as a founder. VC pitch decks look, feel, and smell a certain way. I can always tell when a founder has experience in venture capital just by the way the deck looks. For example, if your deck has a ton of words, mad words, words and words and words, and every page is just words, paragraphs, immediately I'm not reading it. I don't have the time. I can't read it. You're going to lose any investor immediately right away. Not because the information is not good, but because this is not meant to overload an investor with information. It's like you're communicating so much that you're actually not communicating anything. So I can tell by the amount of words that you decide to use. So what should you do then? Well, you should craft a story based on only headlines. Each slide should have one main idea as the headline. And you want the pitch deck to serve the story that you tell, not vice versa. Another common mistake is founders will go and they'll find a template. But what happens with a template is you're fitting your story, which is unique, into a template, which is not. And then when you send this deck, it's a deck that feels very generic and it doesn't allow you to shine. So I'm going to give you my secret tip on how I make my decks. The way I make my deck is I based it on actual conversation that I have with people in real life with no materials. So imagine that you are telling a friend or an investor about your business. Forget about the materials for a moment. How do you open up? What's the first thing you say? What's the second thing you say? How do you get them excited? What parts of the conversation do they lean in? What parts of the conversation can you tell that you're losing them? What are the questions that they ask? Oh, who's involved? Oh, how do you make money though? Well, how big is this opportunity anyway? All of those questions of that in-person actual human dialogue, I pace around a room and I say the flow out loud. And then I begin to, on a whiteboard, write down, okay, so based on how I talk about Loop in person, this is what I want to put first, a vision statement. I don't want to start narrow. I want to start big. And then I want to sprinkle in there something that is going really well for us. We have over 30,000 people waiting to ride with Loop. I'm putting that up front. It's an attention grabber. Then I'm going to weave into discussing the market opportunity and then eventually the business model and so on and so forth. There are plenty of templates out there. You can find them. But the key thing to pick up from this lesson is making a deck that allows you to shine as a storyteller. Don't fit your story into a generic template and don't make your story with a lot of words. Distill it down into the main ideas, slide after slide after slide, and use visuals, but not a ton of photos. Don't use stock photos. Use concepts and images that can visualize what your business is about. For example, if you have a slide about growth, give me a chart that shows your growth. If you're talking about the market opportunity, give me a pie graph that can visualize how big the market is. If you are discussing the competitor landscape, give me an XY landscape and show me where you fit in relation to your competitors. It's all about simple graphics that can visualize your concepts. And it's about having less words that compel the imagination. And just to close this section out, I need you to remember that the main goal of this pitch deck is to get a meeting. The pitch deck is not to get you investment. The investment will come from subsequent conversations. The pitch deck, you have to design it so that you leave just enough open for imagination and just enough excitement that when they see it, they'll say, this looks awesome. Can we have a meeting? I would love to introduce you to the rest of my partners. I want to introduce you to my team. So-and-so that I know would love to see this. Do you mind if I send the deck out to them? The deck is but marketing materials that help you evangelize your story within a particular VC organization. Because remember, these VCs typically have partners and they don't make decisions on their own. They need consensus. And so this material is a light set of materials that communicate the business, but don't drown them with information. It helps you get to the next stage. Hope this helps. So you understand the VC landscape. You understand the players in the VC ecosystem. You've figured out how to identify the funds that are most compatible with your business. And you've even now crafted, with some practice, some compelling set of materials. So what comes next? This, what I'm about to tell you right now, is the hack, other than having a really good deck. This part here is the single biggest key to raising a round for new founders that most people don't talk about. And that is having a process. A process. Now, when I first started raising money, I would keep track of everyone in my head, in my email and sticky notes, and say, okay, now, you have your 100 people you want to go after. Well, oh yeah, I spoke with so-and-so. Oh yeah, did I call them? I don't know. I think I maybe spoke to them. You'll be surprised how many no's you're going to get, and how many conversations you're going to have, and how many people are going to introduce you to other people. And I can make you a guarantee, you will forget. I know it feels like you won't forget, because these VCs are important to you, and they're top of mind. But trust me, they start to look and feel kind of similar, and they're fun. The fund names sometimes are similar, and you're going to have a lot of conversations in a shorter period of time, or it might take a long time. And over a 3 or 4 month period, which is about the time that it takes to raise a round, more or less, you will forget. And so what should you do? Well, you should do what any good business person will do, which is create a spreadsheet where you can keep track of everybody that you're going after. What are the fields that you should have in the spreadsheet? Well, simple. You should have the name of the fund, the name of the partner that you spoke to or wish to speak to, their title, their email, if you can get it, the industry that this fund invests in, their average check size. Oftentimes they'll disclose that information on their website. You should write in there whom you know in common. If you don't know them directly, do you have a mutual connection? Oftentimes you can find that on LinkedIn. You can find the partner on their website, type their name in on LinkedIn, and you can see what are the connections that you can get into this partner. You can also write in there, did you initiate contact? Yes or no. You can keep track of the stage as well. So you can have a drop down that says, okay, haven't reached out, haven't heard back, schedule my first meeting, schedule my second meeting, third meeting, in due diligence, up for, a vote, and ultimately invested, or passed. So those are the various stages that a fund will have with you. So if you need to know where you stand with every firm at any one given moment, and you will not be able to memorize this, because, as I said, for example, at Loop, we had over 134 meetings with over 76 VCs. And so I'm keeping track of all these people constantly. And I literally, a lot of you guys know, you're founders, you kind of have to be obsessed with this stuff. And the only way to be successful in fundraising is to be obsessed with the end result. You must have it right here. You have to think about it all the time. You have to write your goal on the board. You have to write the goal on your notepad, leave a sticky note on your computer, constantly think about it. And you have to write down all the people that you can speak to and say, okay, how can I get an intro to this person? Do I know this person? Where am I at with this person? Oh, I'm on a first meeting. Okay, great. I sent them my pitch deck. Oh, they haven't responded in 3 days. Let me follow up. You can change it. Okay, follow it up. And this, what I'm telling you right here, I'm certain a lot of you will be tempted to ignore. A lot of you will not have the discipline to make this document. A lot of you will discard this or disregard this as optional. Oh, I don't know that many people anyway, or don't worry, I can keep all in my head. If you do not have this, you are increasing your odds of failure. In fact, I would go as far as to say is you will fail. You must have a systematic way to keep track of everybody that you're speaking to. And the founders, from my experience, that run a systematic process vastly increase their odds of success, because that way you are ensuring that every possible fund out there that's looking for you has had the chance to meet you. And many of them will pass. It's not really about, you want to get the money, but also sometimes it has nothing to do with you. Sometimes it's timing or money, or maybe they just invested in another company that was similar, or maybe any number of reasons could be why they passed that have nothing to do with you, is the reality. But the sooner you're getting through this entire list, the better. If you pass, cool, absolutely great. We'll meet again next time, and then you just save them as past. Circle back in the future, and you go to the next one, and you go to the next one, and you go to the next one, and the next one, and the next one, the next one, the next one. It becomes a systematic process. You begin to develop a groove. You begin to develop a momentum. You begin to hear what are the common concerns, and then you can go back and adjust your pitch deck. You can hear what are the common things that people ask about. And if you don't have that slide in your pitch deck, you can make a new one. You can lean in where people get excited. And after a while, you do get much better at pitching your business. And this will increase your probability of getting that first yes. And when you get that first yes for 500,000, it becomes a lot easier to tell the next person, hey, this fund is soft committed for 500 grand. Would you like to jump in, 250 grand? They might say yes. And then before you know it, you now have 4, 5, 6 funds all circling around with interest. And now you've done the difficult thing of creating an oversubscribed round. Now you can increase the amount of capital that you're looking to raise, or pick and choose the investors that you want. But the key to that is running a systematic process. So please do not skip over this if you are serious about raising venture capital. All right, so you did it. You have a ton of people, angels, VCs, all whispering about you. They all are soft committing. They want to invest in your business. So now, how do you take someone from a soft commitment to a firm commitment? Well, as you go through your systematic process, you're going to have a lot of people that say no. You set them aside. You're then going to have a lot of people that say, this is a maybe. Circle back with me. I need some more data to make my decision. Okay? Put them in the maybe. You then eventually will get some people that say, this is awesome. Can we have a follow-up conversation? You have a follow-up. Can you meet my partners? You meet the partners. And then you might meet a reference that they have. And after all that, they still may say no. Okay, put them in the no. After all that, some still might just say maybe. Okay, put them in the maybe. This game takes tough skin. But there will be some people that after all that say, okay, I think I'm in. I would like to soft commit for $250,000, 500 grand, $1 million. The range varies. Then you say, okay, great, awesome. I will pencil you in for this amount. Give me a little time to firm up the rest of the round, because what you will learn is you need to close the round all in one go. You cannot close, typically, you can, but you typically don't close a round 250K at a time, 750K, 500, 100K, 50K, 25K, all in different motions, because your legal bill would be through the roof. And also investors feel uncomfortable with that. So this is the hard part about VC, is you have to get confidence from multiple groups of people, all more or less in a concentrated period of time. So what I want you to do is understand what a soft commitment is. A soft commitment is not, hey, I'm all the way in. A soft commitment is, hey, I have intent to come in. I like the business. I like you. Here's how much I would invest. Tell me who else you're going to bring into this round, and let me know when the round is completed. And when the round is completed, you can count on my investment. So it's a yes for sure. But I don't like to count the money until it's in my account. But a soft commitment is so valuable. Why? Well, because we already established that VC has a lot of FOMO, it's a lot of network, it's a lot of who says, she says, this says, whatever. So the moment I have a soft commitment, I can use that to then levy interest from other investors. I can take the 250 and say, cool, awesome. I may not have it in the bank, but I can talk about it privately to other investors. So then you can say the next time you have a conversation, hey, so I'd love to count you in for this round. You know, so-and-so is in for 250. You know, what can I mark you in at? Or what's your target check size in a deal like this? And then notice the difference of the conversation. The conversation is not anymore, oh, I'd love for you to invest. You know, once you have someone that's soft committed, it raises your confidence. And you can say, hey, well, what should I mark you in for? Let me know. You know, we don't, you know, we're the round is getting tight. We don't have that much room anymore. But I'd love to squeeze you in for your target amount. What are you looking at? And then they may say, you know, then it's the psychology is different. The psychology is you're now letting them into your round, not vice versa. So then someone else will soft commit another amount and soft commit another amount and soft commit another amount. You may have someone that steps up and wants to do what's called leading a round, which means they're going to write the biggest check and take typically 50% of the round with one check, might be $1 million. And then everyone follows underneath this lead. So oftentimes you will have a lead. Sometimes you don't have a lead. Sometimes it's up to the founder to get all these various commitments. And yeah, effectively, as you know, you have to set a target amount that you're looking to raise. It could be 1 million, it could be 2, it could be 500K, whatever it is. Once you tally up the soft commitments and you've raised enough to fill out the round, then it's time to get legal involved. And when you get legal involved, typically your lawyer won't charge you until after you've closed the round. So it gives you some flexibility on the monies that's required to close the round. And oftentimes the lawyer will do it based on these soft commitments. If they know that this fund and this fund and this fund are all going to write in a $250,000 check, then they're not as nervous about their $50,000 legal bill. And one key nugget is it is better to have a lead investor, someone that steps in and says, okay, I'm going to corral all of this investment interest that you've garnered, and I'm going to take the lead. And my lawyer will negotiate with your lawyer, and you and I can craft the board, who's going to be on the board, what the valuation is going to be, what the option pool is going to be, all of these terms that you will learn in this process. There have to be lawyers that figure this stuff out. But if you don't have a lead, then who's your lawyer going to negotiate against? Well, your lawyer is going to draft the documents, and then they would give it to you, and then you would have to get all the individual check writers to agree, and that's kind of difficult. So it's often better to ask someone, hey, are you going to lead this round? You know, we would love for you to lead it, because they anchor the conversations, and the other investors know that there is someone on their side of the table that's looking out for their interests, that's taking the lead on negotiating with you. So now you have your lawyer and their lawyer, and they'll issue what's called a term sheet. A term sheet is a 1 or 2 page document that gives you the high level details on all of the deal points, how much money you're raising, what's the valuation, who's going to be on the board, and so on and so forth. That term sheet is negotiated between the two lawyers. It typically takes about 1 week. And then after that term sheet is signed, then the lawyers communicate directly and begin the closing phase of the process. This typically takes about 30 days, and it will be the longest 30 days of your life. You're sitting anxiously awaiting. But at this point, the investment is largely secure. You have a term sheet that's finalized. You have the smaller investors committed for certain amounts. You have your lead is anchoring it. You have a signed term sheet. And you set a closing date. So then you'll set a date on the calendar. Okay, we're going to close on September 30th. And everyone marches in good faith towards this close. And then the very last step is, if you don't already have a bank account for the business, you make a bank account, you get the wiring information. And on the very last day, when all the documents have been signed, then you circulate the wiring instructions, and all the funds at that point are obligated to send you their money. And the cool thing about venture capital is, unlike private equity or whatever, private equity gives you a little bit of money in different chunks. Okay, we'll give you 25% of the money on this day, 25% of the money when you hit this milestone. In venture capital, you get it all in one go. So when you are successful and you close the deal, you will look at an account and it will have millions of dollars in it, just like that. And it is the most exciting feeling in the world. And you're just overjoyed. It takes you a minute to fully wrap your head around it. You immediately go to Black Enterprise and they will write an article on it, because we need more founders of color raising rounds. And then it becomes about what you do with the money, which is up next. Okay, so you did it. Congratulations. You raised some money. You raised 500K, you raised $1 million, you raised 10 million, you raised 100 million. No matter what it is, you now have some cash money in the bank account. What you gonna do with it, man? Well, it's all about, from this point on, typically hiring. You want to hire great people with the money. I myself, when we closed our seed round, I and my co-CEO are amongst the lowest paid staff on our team. We have much more staff that get paid more than us because we own equity in the business. So does our staff, by the way. But what you want to set is a tone of, hey, I'm the CEO. I'm here to work. Okay. I'm not here for a cushy salary. You're not going to get rich off a salary. You're going to get rich off of creating a big business. And in order to create a big business, you need to hire talented, hungry, earnest, good-hearted people. And that will require money. But the good part is that you have that money. So spend your capital in the early days on bringing in great talent, on building out your product, and on not so much on paid marketing, by the way. I think a lot of people will just go and they try and do a ton of paid marketing. You want to spend more time at first on your people and your product, and then eventually your marketing. But one tip specifically related to fundraising that I will give you is, and this is what the best founders in the world do, okay? Send your investors a monthly update on email. I don't care if it's good news. I don't care if it's bad news. Send a monthly update, right? Because this gives you're now over delivering. In your agreement that you sign with your investors, you are required to furnish financials every quarter, every 3 months. But I want you to over deliver on communication. Send them emails every month with your core metrics. How much money do you have on hand? What's your burn rate, i.e. how much are you spending every month? How is your product doing? What are the key hurdles? What are the key opportunities? And what are your asks from them? Light emails, super light, bullet points, really brief, and send all of your investors these monthly communications. And what you will find is you will keep your investors engaged. You will keep it a transparent process, and you give them more opportunities to be involved. And when it's time to go for your next round, you're not going to be going from in the dark to cold. You're going to have an activated investor base that will be willing to re-up their investment in the next round and make introductions to investors at the next stage. So the good news is we've walked through the complete cycle. The tricky news is once you raise $1 million or $2 million and you've grown your product and your business and so on, it's now time to do it all over again. But if you follow these steps, then you can literally rinse, wash, and repeat these steps for more and more rounds. And the great news is it actually becomes easier and easier. For Loop, our seed round took 4 months to raise. We had 134 conversations, 76 investors. 100% of the communication was outbound. It was me going to them. For our Series A round, which is at the time of this recording, not yet announced, but it will be soon, we raised a round in 5 days. We spoke to only 4 firms, and it was 100% inbound. They came to us. So, it's not always going to be that easy. I consider myself fortunate, but it does get progressively easier because you have more of a footprint in the marketplace. You have more to show. You have more evangelists in the market. You have customers, you have revenue, you have traction. And eventually, you're not pitching them. They're pitching you. And that's what I wish for you. So there it is, guys. My founder's guide to fundraising. I hope this has been super helpful to you. And if you ever want to reach out directly to me, you can do that. I'm at John Henry Style on Instagram, on Twitter, on LinkedIn, on Facebook, on Clubhouse. I'm on every platform, and I respond to every DM. So I hope this helps. I wish you all the best, and I can't wait to see you go out there and raise a ton of money.
Thank you all for joining the Black Enterprise Entrepreneur Summit hosted by Nationwide. We hope this virtual experience has left you feeling inspired, energized, and challenged by the entrepreneurs and business leaders that you've heard from. It is our hope that the information, insight, and resources that you gain today will be the fuel that drives your business to new levels of success and helps us continue to make strides towards Black economic empowerment. Thank you to all the speakers for sharing your expertise, and an extra special thanks to our title sponsor, Nationwide, along with all of our sponsors that made this summit phenomenal: American Airlines, Comcast, FedEx, IBM, JP Morgan Chase, MasterCard in partnership with Fifth Third Bank, and Walmart. Now remember, you can log back in to watch anything you missed on demand. And don't forget to share on social media using the hashtag #BeSummit. And now next month, join us for the Women of Power Tech Conference on October 27th and 28th, and then the Black Men Excel Summit on November 17th and 18th. We're also happy to announce that we'll be going back to live in-person events next year at our annual Women of Power Summit, which is slated to take place March 24th through March 26th, 2022 in Las Vegas. For more information, go to blackenterprise.com/BE-events. Again, I'm Selena Hill, the Deputy Digital Editor at Black Enterprise, and I wish you all prosperity and continued success.